Okay, welcome back. Now we're going to be heading over to a brief discussion on the process of hiring an agent and arranging financing. So basically, a real estate agent, a buyer's agent, performs 7 main roles. They help educate you about the market, basically what's called a CMA or comparative market analysis. So they'll let you know what a property you're interested in is actually worth in the open marketplace after doing some analysis. And I'll explain how to do that shortly. It'll take a look at your wants and needs, and we'll find you what you need on the basic, and then if you want a couple of extra wants in there, we'll make sure we can give you the broadest exposure to as many properties as possible that meet your needs and wants. We'll steer you to homes that fit your criteria. There's probably about 15,000 listings of properties up for sale, so we'll go through that list and we'll find you the exact ones you're looking for that meet your criteria without overwhelming you. We'll coordinate the work of other needed professionals, so lawyers and mortgage brokers and inspectors and everyone to get on your team. We'll negotiate on your behalf, and oftentimes we'll be able to place your purchase offer, and we'll submit it in person to the seller, and that'll help a number of times. It has definite beneficial aspects to it, especially if you're competing against another and you want to have your offer win. We'll review your paperwork and deadlines. We'll help you take care of all the documentation. So PDS is property disclosure statements, strata documents, see if there's any liens on the title, and so we'll pull all those documents, make sure everything's in order, and then we'll solve any problems that may arise. So basically help keep you out of real estate jail. And we'll make sure your deposits are refundable, you have check and balance clauses in your purchase offers, so we make sure all that stuff's taken care of for you. Next off, advantages of buyer's representation agreement. It sets out mutual expectations in writing between you and your agent, and it's called a Schedule A, and I'll show you that in a sec. Commits your agent in writing to getting you into the home you want and help you out. So a lot of times people ask, what does a buyer's agent do? Well, it is help me find homes, and that's 100% actually correct. But what I'd like to say is, yeah, that's as part of my Schedule A, my number one, right up here, number one, is to get you in a home, find homes for you to look at. That's using the MLS, but it's also looking at for sale by owners, knocking on doors, just getting the properties you're looking for so you're able to look at them and expose you to them. But I'm also, as you can see, I've got 21 other things that I add to my general buyers list to protect you and assist you in this process, and added value that I bring to the table. So you can take a look at that and just ask me for a copy of that, and it goes through all the commitments that I have to supporting you in your process. So that's, if you're looking at any buyer's agent, you can ask them to see what their Schedule A is. And that's how it works. Next step is, once you got your agent, you're going to start talking to either a mortgage broker or a mortgage specialist, or going to the bank directly. So 6 steps of financing. You can go to the bank. That's one option. That's how I got my original property myself. You can talk to a mortgage specialist. They work for the bank, but they're somewhat independent, and so they do a lot more volume than the individual bank employees that you're going to be dealing with. So they have a lot of pull internally in the bank, and they can get lots of extra deals done you wouldn't perhaps otherwise do. And a mortgage broker is able to pull your credit once, your credit rating, and then they bring it and package up your deal to a number of different lenders, and then the lenders try to give them and fund the deal. So mortgage brokers have a useful place in the process as well. So you can just chat with me a little bit more to get some recommendations. You can make a loan application and get pre-approved, so that's a good start. Determine what you want to pay and select a loan option. Submit your to the lender an accepted purchase offer contract. Get an appraisal and title search just to make sure everything's all right and the property's price that you're paying supports the value that you're paying supports the price you're paying. And then obtain funding at closing. It's basically that simple. So your mortgage options, 4 basic factors in your mortgage payment are down payment, size of your down payment, the interest rate, the term, and then if you bring in any other characteristics like seller financing or abatement, we'll go over what those are shortly. So understand your monthly payment. Basically, it's called PITI. So principal, interest, taxes, and insurance. So principal that's your profit. So that's your equity that you build up over time. You make those principal payments each month. Interest is the profit the bank makes. That's the bank's profit. They're going to take a big risk on you to loan you a bunch of money, and then you're paid back over time. So that's called interest. That's their profit. Taxes are basically the government's profit. So that keeps the police and fire departments running, and schools. And then insurance is make sure everyone's all protected. So insurance is just in case anything goes wrong. So that's what's made up in most of a monthly payment. Pre-qualification versus pre-approval. So pre-qualification is simply a rough estimate of how much you can borrow. So let's say you make $60,000. You go to a mortgage broker. I make $60,000. They say, okay, you can buy a $500,000 place, for example, $400,000 place. Pre-approval involves a formal application going through, and you provides a formal commitment that the lender stating how much you can borrow. So basically, you have to show them all your documentation. You get everything in a row, everything all organized. You submit everything, and the lender says, "Yep, you're good to go for the next 3 months or whatever." And then you can. It's very, very important because in a situation which we run into in the west side here, and certain parts of Vancouver, multiple offers. If you're bidding against 2, 3, 4, 5, 6, 16 other people, the person who's pre-approved and has their documentation in a row is going to be in a better position than someone who's just pre-qualified. So that's, you want to go through as much of that it's advantageous. You don't have to be rushed when you put a purchase offer in. So get it done. Decide amongst your mortgage options. So if you want a low monthly payment, you can put more money down, or you can purchase a more affordable home. That's your two options. If you want a low down payment, you can use what's called CMHC or Genworth. A mortgage insurance, and that's usually there's a small little fee to that, or you can secure a second mortgage or a line of credit to use that for the down payment. To build equity quickly, you can make voluntary prepayments. You can pay as much as you want. That's very useful in a readvanceable line of credit mortgage, which I'll explain in another part of this presentation. And then to minimize risk, quote unquote, you can take a 10-year fixed rate mortgage. That's the longest we offer in Canada. And you can put down 20%, 30%, 40%, 50%, however much you want to put down. But the reason I don't necessarily recommend that is people say, well, I want to put more down to protect myself. And it's sort of true, but it's not really, because even if you own, or if you've paid off your mortgage to 90%, and you've paid up most of it down, even if you miss 3 mortgage payments and you've paid down 90%, the bank loves you, but if you miss 3 mortgage payments in a row, they're going to foreclose just as if you had 5% down on that property. There's no difference to the bank. You missed 3 mortgage payments, you're getting foreclosed on. So there's no value or benefit. All you're doing by putting down way more than necessary is protecting the bank's interest. You're not really protecting yours. So that's just my opinion, so you can take that as is. Next off, sources of down payment. So realistically, how do Canadians pay for their first down payment on their first home? So this is from the TD Bank, and this is how people actually do it. So 4% of Canadians are putting it down on their credit card, believe it or not. So paying 12, 14, 16, 18% interest, and that's what they're doing. So whatever, more power to them. They have it make sense and works for them. The next step is they borrow money from friends and family. And so they borrow money and pay it back from friends and family. The next step is they accept and borrow money from friends and family, don't pay it back. So basically just what's called a gift letter in the industry. So that's 11%. 37% are using a loan or a line of credit to purchase the down payment. And so they have a line of credit on another property, or they have a personal line of credit. I'll show how to do that. And then otherwise, they're just saving up. So 57% are using savings. So that's how most people are providing their down payment, according to TD. So next is I'm going to get started on our creative financing techniques. So this is just I'll give you a quick overview for a second, and then on the next video we'll go through everything. So basically next I'm going to be doing 11 ways to do little to no money down, purchase real estate property, either investment property or personal residence property for little to no money down. Or what I mean by that is there's always money down. So this is what no money down means. Again, there's always money down. That it just means legally that either a bank or numbered banks, a seller or an investor, and or all the above, provides 95% to more than 100% of the financing for a project, a purchase, investment property, personal residence, or development project. So basically there's a program, it used to be called Cashback, and that you could do a 5% down mortgage, the bank would give you 5% back as a line of credit, and you could have a property. That was very common. You can also do purchase plus improvements. So this is where you buy something to fix it up and renovate it, and so the bank would give you money to purchase it plus more money to do renovations, and then it would be worth more at the end. Usually you do $1 in renovations, it adds $2 worth of value to your property. So that's a very common program. It's Genworth offers that, and CMHC offers that. So that's very common. There's a company back east. So Vancouver Real Estate Club, that's what VREC is there. So VREC. Vancouver Real Estate Club recommended there's a $25,000 line of credit program from a company back east that's trying to get some more market share out here. So they're trying to make some more loans. They're a bank, and they offer a $25,000 sign up for it, and you get a line of credit. So basically, you take that $25,000, put 5% down. That labels you to buy a $500,000 property, up to a $500,000 property using that line of credit. So it's basically simple. That's the number one strategy I teach. No money down. Basically, you're using 100% of the bank's money. Bank's giving you a little bit of money for the down credit, and then they're giving you a mortgage, and then off you go. I'm going to talk about rent-to-own, $2 type and flip, development deals, and joint ventures. And then, so the catch on all of these types of deals is that usually the person qualifying for the mortgage, it may not be you, may or may not be a partner, or it may be a partner, it may not necessarily be you. But the catch is that a person qualifying for the mortgage needs a very strong income, and a cooperative seller oftentimes is required as well. So we'll get started in the next video on creative financing and 11 ways to buy real estate for no money down in Canada.